The ABCs of stocks refer to fundamental concepts that are essential for understanding how the stock market works. Here's a breakdown. A. Assets. Definition. Assets are resources owned by a company that have economic value. Examples: cash, inventory, real estate, and equipment. B. Buy and sell. Buy. Purchasing shares of a stock means you believe the company will perform well and its stock price will increase. Sell. Selling shares can be done to realize profits or cut losses, depending on market conditions. C. Capital gain. Definition. Capital gain is the profit made from selling a stock for more than you paid for it. Tax implications. Gains may be subject to capital gains tax, depending on how long you've held the stock. D. Dividends. Definition. Dividends are payments made by a company to its shareholders, usually from profits. Importance. They provide a source of income for investors and can indicate a company's financial health. Earnings. Definition. Earnings refer to a company's profit after expenses, often reported quarterly. Earnings per share, EPS. A key metric that shows how much money a company makes for each share of its stock. F. Fundamental analysis. Definition. A method of evaluating a stock by analyzing the company's financial statements, management, and market position. Goal. To determine a stock's true value and make informed investment decisions. G. Growth stocks. Definition. Stocks of companies expected to grow at an above-average rate compared to their industry. Characteristics. Often reinvest profits rather than pay dividends. H. Hold. Definition. To keep your investment in a stock rather than selling it. Strategy. Often used when investors believe the stock will increase in value over time. I. Index funds. Definition. Investment funds that aim to replicate the performance of a specific market index, e.g. S&P 500. Benefits. Diversification and lower fees compared to actively managed funds. J. Market capitalization. Definition. The total market value of a company's outstanding shares, calculated by multiplying the stock price by the number of shares. Categories. Large cap, mid cap, and small cap stocks. K. Key performance indicators, KPIs. Definition. Metrics used to evaluate a company's performance and financial health. Examples: revenue growth, profit margins, return on equity. L. Liquidity. Definition. Refers to how easily a stock can be bought or sold without affecting its price. Importance. High liquidity means you can enter or exit positions easily. M. Market order versus limit order. Market order. An order to buy or sell a stock at the current market price. Limit order. An order to buy or sell a stock at a specific price or better. N. NAV. Net asset value. Definition. The value per share of a mutual fund or ETF, calculated by dividing the total value of the fund's assets minus liabilities by the number of outstanding shares. O. Options. Definition. Financial derivatives that give the buyer the right, but not the obligation, to buy or sell a stock at a predetermined price before a certain date. Uses: hedging, speculation, and income generation. P. Price-to-earnings ratio, PE ratio. Definition. A valuation ratio calculated by dividing a company's current share price by its earnings per share, EPS. Purpose. Used to assess whether a stock is overvalued or undervalued. Q. Quotation. Definition. The current price and volume of a stock as quoted on the exchange. Includes bid price, ask price, and last traded price. R. Risk. Definition. The potential for losing money on an investment. Types: market risk, credit risk, and liquidity risk. S. Sector. Definition. a group of companies that operate in the same industry or market. Examples: technology, healthcare, finance, and consumer goods. T. Technical analysis. Definition: a method of evaluating stocks based on historical price movements and trading volumes. Or tools: charts, patterns, and indicators. U. Underlying asset. Definition: the financial asset, such as stocks, bonds, or commodities, upon which a derivative is based. Relevance: important for options and futures trading. V. Volatility. Definition: a measure of how much a stock's price fluctuates over time. Implication: higher volatility means greater risk and potential reward. W. Wall Street. Definition: refers to the financial district of New York City and is often used to describe the financial markets and investment community. Impact: influences global finance and economic trends. X. Dividend date. Definition: the date on which a stock starts trading without the value of its next dividend payment. Importance: investors must buy the stock before this date to receive the upcoming dividend. Y. Yield. Definition: the income generated from an investment, usually expressed as a percentage of its cost or current market value. Tipshammer dividend yield and bond yield. Z. Zero-sum game. Definition: a situation in investing where one participant's gain is equal to another's loss. Understanding: not all investments are zero-sum, but trading can reflect this concept. These fundamentals provide a solid foundation for understanding stocks and investing in the stock market.